Good morning. Welcome to Market Monday. What is it about October? This Wednesday marks 1 year since the market bottomed on October 12th of last year. It's been a bit rocky since then, no? But as we've discussed ad nauseum, rocky periods are a feature of investing, an unavoidable part of it. And one day we'll also look back at these times as a little blip on the screen.
If investing was smooth sailing all the time, we wouldn't get the higher average returns over long periods of time. So that's what we have to do, barrel into these times when we become fatigued or frustrated or stagnant. We need to withstand these grinding times because that's what allows us to participate in the upside.
But what is it about October? We don't pretend to know the why, but here's the what. The what happens in October. Still trending down through October, then bottoms, setting up a strong quarter four. No guarantees, just historically what has happened. And if we go back to every time the market bottomed in October, it probably felt uncertain, uncomfortable, unnerving, but somehow, some way the market found its way higher.
What else? If we look at when the market is up at least 10% through July, check. Then down in August and September, check. The fourth quarter is 9 for 9 for positive gains. No guarantees, just what has historically happened.
And look at this. This is the number of times by month where a 5% or more pullback ended. We can see here there really is something about October. Of course, right on schedule, this sell-off has shifted sentiment back to a bearish tone. The fear and greed index is now at 16, showing extreme fear. Just 1 month ago, it was 58, greed.
Or the AAII, American Association of Individual Investors, after months of being mostly bullish in the June and July timeframes here, I wonder what caused that, has flipped. We now see more bears than bulls. Surprised? Just look at where we were last October. And what was happening then? That's right, the market bottomed.
Meanwhile, everyone's focused on a gloomy stock market. It's the bond market that's been the real thorn in our side. This is no joke, folks. We're currently in the longest bond bear market in history. Over 3 years now, more than double the length of any prior bond bear market. What was largely meant to be a diversifier and a risk reduction tool has not served either of those purposes well. While we're not ready to throw in the towel for good, we do need to consider other sources of diversification. But we remain invested in strategic core bond allocations because, this is from a few weeks ago, bonds can rally back after we reach peak rates.
But that's not the only issue we're dealing with. As we talked about last week, while the S&P 500 flagship US stock market is up about 10% for the year, the Dow Jones is flat and small caps are now down. So is the equal weight S&P 500, where each of the 500 companies has an equal effect on the index. So diversification both across asset classes and within stocks has worked against us this year. And of course, goodness, look at the returns from the market top on January 3rd of 2022. Still down more than a year and a half later. S&P 500 still down 12%. NASDAQ still down 18% despite being up 25% this year. Small cap Russell 2000 still down 24%. Dow Jones still down 10%.
It hasn't been easy out there, folks. Let's stay focused on whatever your priorities and goals are, whether it's income or growth or some combination of the two. The markets are going to rebound. They'll capture new highs again. It's only a matter of time, and we need to participate when that happens. Take care and have a great week.